Welcome to Smokin Bulls, the podcast about business, money, and lifestyle. Today we're speaking about whether or not to have an advisor for investment decisions. I'm Tyler.
I'm Dave.
Let's get into it. Okay, so Dave, we're here today to chat about a lot of stuff that you see in the media right now. You can find it in print media. We see it on advertisements during the hockey games. You'll find it popping up in your sidebars when you're doing any kind of Google searches, and it's whether or not to have an advisor on your investment products. So there's companies out there that promote you going out and picking your own investment, and you're going to reap the rewards by saving a bunch of money on having lower advisory fees because you don't have that advisor involved. We're here to, I guess, discuss that a bit more today and get our opinions on why you would go looking for an advisor, if these products or these solutions fit for some people and whether or not they fit or don't. So maybe we can get into it and get started. What are they claiming, I guess? What do you get from these advertisements? What do you see them promoting as a way for a solution out there?
I think it's a market out there, and every firm is in business to draw assets in. And I think there's some niche players out there now that are obviously after the, I guess you could call it do-it-yourselfers, or if you look at some of the ads, it's trying to attract those who are using advisors, and they're trying to entice them to not use an advisor, save some fees, come over and do it yourself. And I think that's the big push there. I guess the question is whether it's working or whether it's not working. Some of those platforms have had great growth, but we've been in this long enough. Great growth always seems to come for investment firms when the markets are good. So what happens when the markets are bad?
And that's a good point. I've always noticed that you see those advertisements and you hear from those companies a lot during bull markets or when markets are rising. The second the market turns and we're going through turmoil in the markets, or you're seeing markets drop, it's like those advertisements disappear from the face of the earth and those companies no longer exist. So it almost feels like they're pandering to a bull market where you can throw a dart at the board and make the right decision. Yeah. And you're going to get into a product like that where there is no advisor compensation because you've picked it on your own, and you're going to reap the benefits of simply being involved in a frothy market.
Yeah, I think those ads, those companies, they go at it in a more complex way too. They have lots of tools online, so you're using their tools to come to your investment decision. They're providing the investment options. You're navigating yourself to that decision. And I think that's the big one is, are they saying you're your own advisor? No. Are they saying you're advisorless? No. Are they saying you have an advisor? Well, sort of. An online virtual advisor. It's like going anywhere. When you first used to go to the bank, you do your asset allocation, you score a 58, and they show you all the funds, and across the top is like a measuring stick, and 58's over here, and you start to look below, and you get yourself to where they need to get you to, right? So I think that's happening here, and the math is always the crazy part. It's like, well, you can save 30% or whatever some of the claims are. 30% of what?
30% richer, I think, is the one I remember. Yeah.
30% richer.
30% richer.
Yeah. I guess
that's at the end of it. I think that's when they hit retirement, they're 30% richer. At least that's how I understand the advertising.
We've analyzed some of those, and net of all of expenses, things of that nature, sometimes you're not really richer. It just doesn't work out that way. The thing some people are probably great at being their own advisor. My uncle, the guy was basically the equivalent of portfolio manager without any designations. He was trading his portfolio. That was his hobby and it was his job. And that's what it is. If this is your hobby or what you want to make your part-time job, managing your own money, go for it. If it was all just about picking an investment, then that's the easy part. I think part of having an advisor is it goes beyond picking an investment. In Canada, just the way advisors get compensated for the most part, other than fee-only planners, is they get compensated based on the assets they manage. I think it's important if you're doing the advisorless method or you're following, these TV ads and everything, you just have to be willing to accept that, maybe you do make a little bit more money because you don't have an advisor. But what is the cost of that advisor? And I think it just gets a bit complex as to truly how is someone compensated and what job are they doing for now? We can tap into that too. Not all advisors are created equal. There's we know people in the industry have, effectively retired, but they're still your advisor, and there's, phone calls or call forwarded to a 1-800 number to handle any inquiries until it gets back to the advisor and they get back from a trip or whatever. I mean, it's all relative. It's, I think, up to each individual to figure out where they want to go here.
Yeah, and I guess basically the promise here of these systems is that their performance is just as good or better than anything that an advisor is going to put you in. Otherwise, it's impossible to compare these two things. So I guess if you want to compare not having an advisor, and if you're just talking about selecting an investment, then the investment that is selected has to be the same on both sides. So the advisor would have to be putting in the exact same style of investment as the system is lining you up with. And then if the returns are going to be identical, then yes, you're going to be further ahead in the investment without an advisor because they're not taking an advisory fee.
No, but they are taking a bit of an advisory fee. I think that's what's unique is, when we manage assets, we have basically, there could be a product cost for the manufacture of the product that we're using, unless we're picking our own stock. And then there's the advisory fee. And then sometimes you might have a trust, an annual trust cost. There might be some other small charges. So you add those all up, that's your fee. If you look at just some of the online systems and using the portfolios that they've put together, in the fact that you're running it, they're charging you, a fee for the product. And there's a bit of a charge on top of that for using their system to get you to that product choice. Right. So I don't think, I think it's just semantics with words sometimes, but, the commercials they grabbed your attention, obviously. A lot of people feel like they're, feeding more than their family and all these other pieces. And I think it's a matter of what is your goal in life? If it's just about your investment account, go ahead. But the day you have to decide to make a decision, so you have to make a decision on, is that supposed to be an RSP or is it supposed to be a TFSA? Should I open an RESP? What's the right combination of all those things? I've got to buy a house. I need to buy a car. Where do I take the money from? I think people, sometimes those decisions are what blow up everything, and not even just investment decisions. I mean, we all know, for the most part, human nature, markets start to tumble. Some people want out. Markets are at an all-time high. People want to buy more. I mean, we don't really follow the right protocol, of buy low and sell high when we're on our own. And even some advisors probably have trouble with that sometimes. But so left to your own devices, if it's just investment decisions, there's pitfalls all over. When you start mixing in life decisions, there's even bigger pitfalls. And your advisor, if you have an advisor, they should be, they're providing advice beyond the investment. If you just get investment advice for your advisor and they're taking a good chunk of the return, well, okay, you've got to look elsewhere. Go ahead and interview. I mean, I would interview an advisor, and I'd have a chat on the 1-800 number with these different firms and ask a lot of different questions.
Yeah, and I mean, you've touched on a couple of things there around having actual advice around your investments that don't just pertain to the investment itself. So people are going to make mistakes on their investment selections, and that's, I think, what those commercials focus on, is really just selecting your investment. And if you're working with an advisor, then they should be providing advice far beyond just the investment selection. And I think that's a key thing to focus on, because that advice is sometimes typically worth way more than any of the fees that they're ever going to charge on that investment account. So the advice that comes with that pretty much wipes out any advisory fee that they might be running into. So advice around your taxation of your investments is I think, critical. That's a key. People will take money out of the wrong accounts and at the wrong times if they're needing to access funds, and they may be saving into the wrong types of accounts as well if they're in an advisorless program. Mm-hmm. So it is really important to have guidance right from the start as to what type of investment you should be using, what type of registered investment you should be using, in preparation of what you expect your future life circumstances are. Mm-hmm. So you're right. Without an advisor, that program isn't going to help you very much with picking that style of investment. So the investment selection is one thing. The life advice, the wealth advisory advice that goes around the investment selection is, I think, key and probably more valuable than just the investment selection. If
you're new and you're just getting your feet wet, I don't think it's a bad way to go at all. But like I said, when it comes to that first lifestyle decision about, oh my gosh, we had a baby, do we get an RESP from the bank? Do we buy it from this company? There was a lady at the hospital, gave us her card, and she does RESPs. I mean, the second that you have to make a decision on your own every single time, on a financial decision that comes up. You're going to make a mistake at some point. I mean, we could jokingly say, you think of what we say to our clients. Look, investments, it's hard to beat the market. It's going to be very hard to beat the market. So why not just buy, something that flies with the market and gets you basically very close to the rate of return of an index. We always say, look, our goal is to kind of earn our advisory fee. So get you basically the advisory fee back and get as close to the benchmark as we can with less risk. So there's a lot of different pieces that you have to do that. If you want just the return of the market, you're going for a ride and you might not like the ride. So, look at it this way. What is your rate of return? Subtract the costs of earning that return, whether it's an advisor fee, whether it's an account fee, whether it's the management fee for the underlying product, which minus the taxation of whatever you had to pay in tax for that investment each year, and throw in the minus the mistake cost. And that you can do that for your advisor too. Did your advisor make a mistake, I guess? But what mistakes did you make? Subtract all those numbers and keep track of that in an Excel spreadsheet and find out what your annualized rate of return is over a period of time.
Yeah, and that work that you're suggesting is going to be somebody who's probably keen on handling their own investment portfolio. Mm-hmm. For somebody else, they're going to be looking for an advisor to make those decisions, avoid the mistake side of it, and get their advisory fees back on actual advice that's saving them. So I think what we're leaning to, obviously, and our background would require us to say this, we promote having an advisor in your corner when it comes to wealth management decisions. So on investment decisions, insurance planning decisions, you name it, you need somebody that can bundle those together and show you how it affects you into the future. So how does somebody out there go about finding an advisor? Is it just picking up the phone and calling the bank? Is it talking to friends? How do you begin finding an advisor? Any tips?
I think all of those ways. I mean, we spend more time in any given year planning for a vacation. So to try and find an advisor, you've got to talk to people who have advisors. Why not go see somebody at the bank and go talk to somebody at a 1-800 number? I mean, let's face it, for the most part, the advisorless system that's being promoted out there is not affecting our business. I think what it is it's a fight to take the bank's business. So the question is, are people getting advice at their bank branch? And if they are, they're still doing the same asset allocation questionnaire and getting to the final investment choice. When you sign a document, you're signing that you picked it. No matter how much you got rammed down the funnel and came out the other end, you picked it. Right, and that's just the way it's going to work. So, what are you paying for that? I mean, the management fees on some of the funds at the bank are very high. So what they're saying is, look, come over here, and we'll put you in some very cheap stuff. You're still really going to pick everything yourself, even though you don't feel that way, and it's just a different way. So I think that's primarily the target market. But whether you're coming from an advisorless system that you've been doing it on your own, at some point, everybody starts looking for an advisor for help. And I'm saying everyone, but there are some people who are just born to be in this job but aren't in the job, but they manage all their own affairs. They manage their family's affairs and they're good at it. That's hard. That's just, there's so much that you need to know, I think, and there's so many mistakes to be made. So in essence, I think I ran around the circle of your question here, but you need to talk to different people and get some an interview. If you are looking for an advisor, well, you don't have to pick the first one you sit down with. I mean, that's their job. They know how to greet a new client and they know how to make a new client. You might want to hear a few different opinions. And I think we've talked about it. I think it's on our sheet to have a talk about, but financial philosophy is a huge one.
Mm-hmm. It's a chemistry sort of thing. And I did have a note on it is whether or not you feel comfortable working with the advisor. And that's any advisor you sit down with should be able to portray, what their philosophy is around how they manage money and how they manage a client. And it should feel comfortable to you in that conversation. If they're telling you something that doesn't feel right or sounds stressful or uncomfortable, then you got to go on to the next one. And everybody's level of comfort is different. Some advisor may sit in front of you saying he loves to trade in the markets and he'll call you at 7:30 in the morning on a Tuesday and tell you we're getting out of company XYZ to go to company ABC. And you may like that ride and that rush and excitement that comes with that, or that may turn you right off. And you need to go to an advisor who's saying we build a diversified approach and it's steady as she goes and it's not designed to fluctuate that much. I mean, you got to find what the right fit is. So you're right. It's a financial philosophy that has to match up. And that's one of the key components, I think, in picking an advisor. It's something that we talk about with our clients when they first come in is, this is our philosophy around money management. And what's your philosophy around it? How do you feel about what we're saying? And that's a pretty open conversation out of the starting gates.
Yeah. I mean, there's so much information online, and everybody knows with online information, if you stay on it and read long enough, you might be stuck because you're going to have 50 reasons why not and 50 reasons why.
Yeah.
If you remember The Wealthy Barber, I mean, that's probably one of the best books to get somebody introduced to just the little pieces of investing, a little piece of insurance, a little piece of estate planning. It's kind of all bundled there. And that, to me, it was a great book. I mean, crap, when I was first starting out, we used to give those books away. I mean, that was, so anybody who's looking for advisor, I'd say that's your first book to read. And it's an easy read. I mean, you'll knock it off in a couple nights type thing. But yeah, there's just starting points for everybody. And sometimes it's your family. And of course, many of those ads take a real good knock at, using the same advisor as your family's been using. It's kind of like you're old and stodgy or something, or you're out of touch with reality, or I don't know.
Well, I know one of the things that we've guided our clients on too when they're shopping around is and sometimes it's over emphasized, but looking for credentials. Sometimes the amount of credentials that can come under or behind an advisor's name is like alphabet soup, we call it. We don't know what the credentials are, especially if you're not in the industry.
I don't even know what some of them are. Yeah, I am in the industry.
It's crazy how many.
I got a credential press under the table here. I'll just punch out a CBG.
So there's certain ones to look for. I mean, for us, I know we've always referenced the CFP, the Certified Financial Planning Designation. Another one on the investment side is, a CIM, a Chartered Investment Manager, or CFA, Chartered Financial Analyst. Some of these designations carry with them fiduciary duty. So that's a key component. Some designations don't have a fiduciary duty. Maybe you can talk a bit about fiduciary duty and what that means in an advisor-client relationship.
Well, I think keeping it somewhat general in a way, most people would feel when you're working with an advisor that they have a fiduciary duty to make and guide you with choices that are explicit for your situation and not tainted by anything else, not tainted by the advisor's view of their own situation or compensation or product that they like somebody from that firm or all those things. It's fiduciary duty means they're making every move that they make is about your interest and your interest only. And portfolio manager, CIM, there's your designation. Anybody else that's holding many of the other designations, there is no fiduciary duty. Now, that doesn't mean the advisors aren't acting in a fiduciary duty. I remember when we went through all the process of getting the different designations, I think I was surprised that this meant I had to act in a fiduciary way. And I'm thinking, I thought that we've been doing that all the way along. So, but for anybody who is got money out there with anybody who calls himself an advisor, it'd be interesting to ask, are you bound by a fiduciary duty, and not just your own moral compass, but do you have a fiduciary responsibility with your designations to provide me unbiased advice? And
essentially you lose that designation if you're ever challenged and it's proven that you're not upholding that fiduciary duty. So most advisors who have those designations are going to be pretty strict and follow them quite closely because it jeopardizes their business and their livelihood if they're not. Let's see, any other points that we can think of that we need to touch on when searching for an advisor? I guess if you do have it narrowed down to 2 or 3 advisors that you like, the next step would maybe be talking about getting client referrals from those or client testimonials from those advisors. I think that would be one to key in on when you're talking to an advisor. We've had to do it for new clients coming in our door. We've got clients who we have spoken to and said, would it be okay if we share your name and contact information with potential new clients? And then they're usually happy and willing to share their experience that they've had with us. That would be an important point. I think once you've narrowed down your advisors, you've looked at credentials, you've looked at a financial philosophy and a chemistry between you guys, is actually talking to client experiences and finding out about what it's like to actually work with that team.
Yeah, I mean, let's face it, a client testimonial with someone phoning them for almost a reference or whatever. We know the clients we're giving names out to, and we know they work with us well and they like us. But even with that, a potential client's gonna ask a client different questions than they're gonna ask us. And it's not something we've ever really discussed with a client. It's like you bring somebody on as a client 5 years later, you go, so what did you like about us when we first got going? What were all the things that made you decide to go with us? I don't think I've ever asked that question.
No, I don't think I have.
So, but that's going to be what a potential client's going to talk to a client about, and only those two can have a discussion of that nature, I think. So yeah, I think that one's quite important. And I think the philosophies, financial philosophies, investment philosophies are pretty key here, because there are different styles. There are different advisors who do different things. There are advisors who act more like quarterbacks with different professionals. There are advisors who we're investments only and we're really good at it. Here's our track record. We smashed it out of the park. You want any tax advice, any financial planning advice, go see your other professionals for that. So there, you got a handful of different things that you can choose from, and it's finding the right one that matches up with what you're looking for.
And one of the things I guess people can use as a resource is the Financial Planning Standards Council. So I believe their website is fpsc.ca. You can go to that website, and that website has a resource of knowledge there for how to find an advisor. Even finding advisors in your local area will narrow the search down based on your postal code. So some of these tips and that we're discussing are pulled right from that website, but it's also stuff that we live by. So I guess that can kind of conclude our conversation around why to have an advisor, because we're big proponents of it, and a bit of a discussion, I guess, summary on what it's like to have an advisorless system and why you would go out there and look for an advisor.
Well, yeah, website crashes, 1-800 numbers that can't be answered sometimes because it's too busy.
They can't even trade when there's we last saw that I think was March 2020 when the pandemic first
came in.
It's
pretty hairy, but yeah.
Markets were dropping pretty quickly.
But if you're advisorless,
programs you couldn't trade
who's
on.
your only handholder at that point? The website or the 1-800 number?
Yeah,
so in the biggest time of crisis, you're going to have to wait to find an answer.
Yeah. Which might have helped a lot of them. If you didn't sell through that period, there was a great recovery right after that.
That's how those advisorless companies do it, and they gate
Buy
it.
and hold.
They gate it. They gate it for 4 days because the phone won't ring or the website's down.
Yeah.
Therefore, you won't make the mistake of selling at the wrong time.
That's right. Thanks for catching this episode of Smokin Bulls. You can learn more about us at smokinbulls.com or follow us on social media. Thanks for watching this episode of Tower Wealth Advisory podcast series. To learn more about us, go to towerwealth.com or follow us on social media. Welcome to the Tower Wealth Advisory podcast series. Today we're speaking about whether or not to have an advisor on your investment decisions. I'm Tyler.
And I'm Dave.
Let's get into it.